Hello, dear investors. Welcome to our fourth webinar. Okay. And our fourth theme, the first steps in the world of finance. Practical examples how you can invest through diversification of your capital and how it works. In previous webinars, we spoke a lot about infrastructure and instruments. Now you can easily speak at the same language with professionals in the world of finance and you can partly understand what they're talking about. We discussed why it is necessary to build your own financial plan, choose your aims, and formulate your rules in time. It's clear that without correct plan, nothing will happen. So it's very important. And first thing what you need to do is to build your own financial plan. Okay, let's look at the second picture. And please, never forget, we are always beginning with the same thing, is risk management. You need to clarify for yourself how much you can be risky, how much you can lose your money. If you want to be a clever investor, let's do it from tight risk management. If you can save your capital, you will find possibilities. Maybe not at once, but obligatory you will find. And at this webinar, I'll show you few practical examples how you can conservatively diversify your capital, and I'll speak you about very strong mechanism of diversification. But firstly, let's speak about the simplest strategy and the most popular strategy. Why is it so important? Why is it so popular? Because it is simplest. What you need to do is simply buy an instrument and hold it all your life. The idea is to receive dividends. Totally, it's a quite a good idea and sometimes it works great. So this strategy named buy and hold. And look at this chart. It doesn't matter where you invested your money. You are in profits in long-term timing, and you have 2% of annual dividends in S&P 500. Yes, it's very uncomforted during crisis in 2008, but following your rules and controlling risks, all will be okay. So it seems to be all great. But let's recall once again. Dow Jones from 1929. Only after 1915 Dow Jones Index restored. Long 20 years of your patience. Are you ready for such trials? And yes, it's look great at price history. But are you ready to wait 20-year drawdown? If you will do it according to your financial plan, for example, partially invested month after month with equal parts, so then it will be clever. But if you will invest all your savings at the same time at the highest price, it will be very cruelly to suffer until market will recover again. If it will recover soon, but if not, I'm sure you are still remembering this chart of Nikkei 225. It's Japanese economy, one of the strongest economies with big potential, but sometimes appear a big bubble and price index can be overrated. Why is it can happen? Let's refresh our first webinar. First, you can remember debt problems all over the world and still not solved structural problems. The main driver of growing economy is fact of printing more money. And a lot of investors know about it, and when lack of confidence will reach the highest level, it will be sharp drawdown, and you must be ready for such scenario. It's not bad, it's opportunities to buy soon. Second, psychological risks of long-term portfolio drawdown. If something has never happened, then no one believes it happened. But if it happened for the first time and it happened very painfully, so you will be more careful and fearful, and first signs of weak economy will prompt you to close your risky instruments. Third, competitions and big bubbles. Tight competition between largest banks, hedge funds, and professional investors are also untwisting prices. Thus, higher prices will be supported simply by largest players on the financial market, trying to push prices higher. And the aim is simple, to do big profits, thanks to cheap money. And something, it even doesn't matter if economy is not enough strong. But finally, the result of any bubble is only one. So you can remember example of Dow Jones 1929 or Nikkei. Fourth, a new type of instruments allowing to copy indexes. Earlier, if you want to build professional portfolio, you need to go to the professional hedge fund where they will propose for you different types of portfolio. And for their work, you need to pay a commission. But commissions not from your profits. You need to pay commissions from your total invested capital. Such hedge funds do not want to wait ages awaiting rewards. So, appeared instruments such as CFD and ETFs that allow for investors to buy portfolio without such additional commissions. So, what's happened? Now such hedge funds need to work riskier and to show better profits than index S&P 500 to attract clients, and once again competitions, and once again bubbles. You have just seen Dow Jones and Nikkei indexes, and now let's look at this chart. This is a chart of professional asset manager. It's really is a professional asset manager, but as I said, it's market and all is possible. As investor, you need to manage your capital very clever, controlling your risks and diversify your money. Yes, market can give you good possibilities to beat banking and market average return. But while hunting for profits, large parts of investors forget about risks. And what's happened too often. All eggs to one basket. And then headache and trying to find guilty. But it makes no sense trying to find guilty. Money has already lost. So you need to prevent such scenarios, and we will speak about it a little bit later. Okay, what reasons can affect even for the professional trader? First, psychological risks, and second, strategy risks. The first one is the most dangerous, and it will be effectively regulated by the automatic system of risk management that exists only in company Gerchik Co. It means that if a trader risks limit reached, the investor will be automatically disconnected from the asset manager. The aim is simply not to lose more than you expected firstly. And second is strategy risk. You need to know that exist ideas and strategies that can give perfect results for years, but market can change and some strategies need to be adapted for a new market environment. But before asset manager will find where to adapt his strategy, he can lose money. An investor need to be prepared to save his capital by clever dividing his capital. Thus, you need as an investor to make two effective paths to build clever financial plan, what we're talking about in webinar 3, and to make capital diversification that will give us additional safety and advantage. And let's recall once again about clever financial plan. So you need to calculate your expenses from the income. Then you need to determine your life financial aim and to calculate how much money you can risk now for the bigger future profitability. The second part is your money for investments. Okay, now let's speak about rebalancing and how to improve the most popular strategy buy and hold. You need an advantage, and rebalancing is the best and safest way to manage your capital. So, rebalancing is bringing parts of the portfolio to the former ratio. Let's look to the next picture. I drew a schematic mechanism of rebalancing. For example, we have $10,000 of our investment capital. So, first, what we need to do is to divide our capital into several parts. We named it diversification. In this example, we divide it into parts. Then existing different ways of rebalancing by timing and by technical analysis. For example, if we choose rebalancing by timing after definite time limit, we need to bring in parts of the portfolio to the former ratio. And look at this example. Definite time we have minus 10% from one risky instrument and plus 1% from instrument which gives fixed income, for example banking instruments or obligations. So we have total capital $9,550 and drawdown of minus $550. Thus, we need to rebalance this amount of capital to the former balance at 50-50%. Okay, what is the idea of such rebalancing? Look at this picture. It is not a martingale. You need to understand that indexes and shares portfolio have a limited risk. It's clear that all companies practically cannot be bankrupt suddenly and immediately. So you see that if the price lower, then lower your risk in risky instruments such as shares, because all the companies have a fair value thanks to assets value or value of intellectual property. It means that the lower price, the more aggressive we can buy because of limited risk. You can see here the value of risk and here the value of risk. So, according to the rule of rebalancing, we need to bring in parts of the portfolio to the former balance. This example simply sent a part of capital from safe assets into risky assets. So the ratio was the same. In this example, 50-50%. And now I show you practical example of such rebalancing in very dangerous moment when index was at its maximum before crisis 2008. Look at this picture. If you invested all your money by the simple strategy buy and hold, you need to suffer from big drawdown during crisis at 2008. And this drawdown was more than 44%. With annual profitability at 21% because we have additional plus 2% of annual dividends in index S&P 500. But it was a good example. You remember it can be like Makeev. And thus you will not cover drawdown through dividends. But thanks for rebalancing in such dangerous situations, you have limited and well-calculated risks, and you see your risk at 24% instead 44%, and total profitability also higher. And you see in this calculation clearly how mechanism of rebalancing practically works. And it's only one simple variation how you can work through diversification and rebalancing. Okay, we spoke about how to work as an active investor and how you can invest through risky and safety instruments. And now let's speak about how you can work as a passive investor through investing into asset managers. You need always remember that capital safety is the responsibility first and foremost of the investor. So, first, what you need to do is to analyze key factors of asset managers' effectiveness. And first, maximal drawdown is a value of maximum possible loss from your account. This number gives you a basis for calculating the amount of capital for each asset manager. And do not forget, do not put all your eggs in one basket. Second, profitability. That depending on strategy and risks. But your choice will always firstly will be from risks and maximum drawdown. Of course, if you see near zero profitability or sporadic unsystematic growth, it's not interesting for investments. Third, account's age. The longer the account existed, then better. But it's better to choose an account with a history of more than 6 months. And profitability curve. Here you can see a simple example of profitability curve, and it's a normal strategy based on trading of probability. I mentioned in the first webinar, if we are not insider, we can't do any clear predictions. But as an asset manager knows the advantage of his system of trading, and he trade probability with clear mathematical basis. So losses will be an unavoidable part of the system. Thus, a drawdown will be also a part of trader's strategy. But clever mathematics in long term gives an advantage and growth of the account. If you see growth of capital without drawdowns or 100% of winning trade, let's always remember that it can be a risk of martingale system or sitting out losses by asset manager. And it's too dangerous approach. So let's look at this example. We have four asset managers with different risks, and its first column, current profitability, second column, and time of existing TIMA account, third column. And we can calculate annual profitability simply divided current profitability column 2 in the time of existing TIMA account, column 3. And to multiply by the days per year. And do not forget about asset managers' reward. Then we need to determine the value of risk that we are ready to suffer. For example, we decided to bring risk no more than 20%. If we have $10,000, the value of risk will be $2,000. It's 20%. $2,000 we divided into 4 asset managers. So it's $500 for each asset manager. And then we can calculate the amount of capital we need to invest for each asset manager from their maximal drawdown. For example, if it's 30%, so we need to divide 500 by 30%. And we have 1,666, the first asset manager. Then 2,500 for second, etc. So, and our final distribution will as follow at this picture. You see that we invested only 85% from $10,000, and it's connected with risks. Our risk value no more than 20%, as we expected first. If we invest all our money, all $10,000, this risk will be more. It's of course your choice. So then, expected profits. Your expectation can be very optimistic, but let's be realistic, and on the market all can happen. For example, let's look different scenarios. This is why I propose not to put all your eggs into one basket. Even if in this scenario that we have a mistake choosing asset managers, our diversification will give us additional safety and even profitability more than banking fixed profits. You see, of course, if all will be okay and we'll realize our optimistic scenario, we will achieve more than 50% of profits. But even if two of asset managers will be unlucky with their strategies, we will be also in quite good profits, and these profits this profit level will be much higher than banking percentage, such as deposits or obligations. And this is only a simple example of clever work with demo account. Of course, you also can work through rebalancing. You can analyze key features more detailed. But the main aim of those 4 webinars were to prevent you from great risk and to make a first path to clever investors' way. So I wish you a competent approach to your investments and always work from risks. Good luck, and I wish you all the best. See you.